All right, let's check in on the fixed income markets, what the outlook over there is over here in India. And we've got Kilol Pandya, who's head of fixed income at Daiwa Mutual Fund, joining us on the show. Kilol, the yield on the 10-year bench, on the 10-year bond, the new one at least, is holding steady 8.11% as we speak. But liquidity tightness continues to be a big concern. We've seen the liquidity deficit rise to 1,30,000 crores. Call money rates about 30 points above the repo rate. What's the outlook there?
Yes, liquidity continues to be an issue. To some extent, it is expected because we are very much in the month of June, where we have tax outflows. Probably we are at the fag end of the tax outflow season, and the money should start returning back into the system in some form or fashion towards the end of this week, probably beginning of the next week. Nonetheless, the underlying pressure on liquidity continues to exist. We have RBI's quasi CRR action, which was done by way of export refinance measures, which will become effective on 30th of this month. That is expected to inject about 30,000 crores, potentially 30,000 crores into the system. Hopefully some of that will start trickling into the system almost immediately and also ease the liquidity situation. Nonetheless, we remain comfortably above RBI's own comfort zone of -1% NTDL, which roughly works out to be -65,000 crores. I don't believe that situation will change. We may settle back to our levels of about -80,000 crores sometime in the near future.
Kilol, the RBI did go ahead and address that particular point of liquidity shortfall in the system by saying that they have undergone 4 OMO operations in the month of May and that they will continue to do so as and when required. Do you think that this is likely to be in comfort to the bond market, and how much?
Most definitely. We have been maintaining that OMO is a more refined route of injecting liquidity into the markets. It injects liquidity in an orderly fashion, which is very much more in control of RBI. Now RBI has explicitly mentioned that it will engage in OMOs as and when it is deemed fit, which definitely brings comfort to the market. It tells us basically that RBI will not let the liquidity situation go out of control for any prolonged period of time. It is a point of comfort, definitely.
But do you think that the bond yield is likely to fluctuate and be a little volatile until and unless we garner more details with respect to the quantum and the timing of these OMOs?
Yes, some form of OMO calendar has been on my wish list for some time now. Unfortunately, it's not been forthcoming. If we have a larger clarity, more clarity regarding how and when RBI plans to inject liquidity into the market, it will definitely reduce volatility because it will clear up expectations. Nonetheless, one also has to keep in mind that surprise is an essential element of a monetarist approach. So I believe RBI in its wisdom is doing the right thing by keeping cards close to its chest. So yes, the volatility will be there more than what it would be if there was more clarity. Nonetheless, I believe RBI will ensure that it doesn't go quite out of hand. As George mentioned, the 10-year has been holding steady in spite of the lack of clarity.
Right now, Kilol, after the RBI chose not to tinker with rates against what the market was expecting, you had a lot of people, market analysts, beginning to build up expectations that you will see a quarter-point cut now on the 31st of July. But after what the RBI governor said yesterday, where he came out very strongly and said that there is no way that they can reduce rates given the challenge of inflation, would you still expect to see them do something on the 31st?
As things stand now, I'm not of the opinion that there will be a cut on 31st. However, there are certain conditionalities to what the governor said. We expect, or RBI expects, fiscal measures to be taken, some clarity on how the government plans to tackle fiscal deficit, fiscal slippage more importantly, how it plans to bring about, basically bring about fiscal consolidation. If clarity emerges on those fronts, then RBI's stance might undergo some amount of change. Inflation is another issue which RBI is watching very closely. If for some reason inflation does come off, then I believe it will provide another point for RBI to tweak its stance. Both put together, in case we see some fiscal measures coming about and inflation seems to drop, then RBI will, I believe, undergo or change its stance. And if that is the case, if both these factors are coming across strongly, then why wait for 31st July? A cut can come before that too.